Today we are going to discuss stock market tragedies around the world. Let's get started. Stock market tragedies refer to significant events that result in substantial losses for investors and disrupt the stock market. These events can be caused by a variety of factors such as economic recessions, sudden changes in market sentiment, government policies, or unexpected events such as natural disasters or pandemics. When a stock market tragedy occurs, stock prices can drop rapidly, leading to significant financial losses for investors. The consequences of a stock market tragedy can be widespread, affecting not only individual investors but also the overall economy. The 1929 Wall Street crash, also known as the Great Crash, was a catastrophic event in the history of the stock market. It occurred on October 24, 1929, and is widely considered to have been the start of the Great Depression, a period of widespread economic hardship that lasted for over a decade. The stock market crash was caused by a number of factors, including an increase in speculation and overproduction, a decrease in consumer spending, and a lack of confidence in the banking system. The crash was characterized by a sudden and severe drop in stock prices, with the Dow Jones Industrial Average losing nearly 25% of its value in a single day. The panic that followed the crash resulted in widespread selling, leading to further declines in the stock market. The aftermath of the Wall Street crash had far-reaching consequences, affecting not only the stock market but also the wider economy. Black Monday, which occurred on October 19, 1987, was one of the largest one-day stock market crashes in history. The Dow Jones Industrial Average lost over 22% of its value in a single day. The causes of the crash are widely debated and include a combination of factors such as computerized trading, a strong US dollar, and global uncertainty. The rapid and sudden decline in stock prices caused widespread panic and selling, leading to further declines in the market. Despite the severity of the crash, the stock market quickly recovered, with the Dow Jones regaining much of its lost value in the following weeks and months. The dot-com bubble burst was a significant event in the stock market that occurred in the early 2000s. It was characterized by a rapid increase in investment and speculation in the technology sector, particularly in internet-based companies, which resulted in an asset bubble. Many investors were convinced that the new internet-based businesses would revolutionize the economy, leading to an influx of investment capital into the sector. However, the bubble eventually burst, as the optimistic projections of these companies' future growth and profitability proved to be unrealistic. The 2008 global financial crisis was a significant event in the global economy that had far-reaching consequences. It was caused by a combination of factors, including subprime mortgage lending practices, the collapse of the housing market, and a lack of regulation in the financial sector. The crisis had a significant impact on the global economy, leading to widespread job losses, decreased consumer spending, and a decline in economic activity. Many financial institutions, including banks and investment firms, faced bankruptcy, and governments around the world were forced to intervene with bailouts and stimulus packages. The COVID-19 pandemic had a significant impact on the stock market in 2020. The rapid spread of the virus and the global shutdowns and restrictions that followed resulted in a sharp drop in economic activity and a major sell-off in stock markets around the world. In March 2020, the S&P 500, a benchmark index of the largest publicly traded companies in the United States, experienced its worst month since the Great Depression, with a decline of over 20%. The rapid decline in stock prices was driven by a number of factors, including uncertainty about the severity of the pandemic and its potential impact on the global economy, concerns about the solvency of companies facing disruptions to their operations, and the widespread panic that often accompanies major market downturns. In response to the crisis, central banks and governments around the world took a number of measures to support the economy and the financial system, including reducing interest rates, providing fiscal stimulus, and launching large-scale asset purchase programs. The role of government regulations in the stock market is to promote stability, transparency, and fairness, while also ensuring that the stock market remains an efficient and effective platform for investment and wealth creation. Effective regulation helps to mitigate the risks associated with stock market investing, while also creating a level playing field for all participants.